I was going to start this video with a big de la soul moment. Had it all planned out, a cheesy rendition, this hat. I'll sort that out later. I was maybe even going to do some of my best dance moves, but you'll be glad to know that my wife taught me out of it. Probably for the best, actually, because it turns out I got the lyrics wrong anyway. Whereas De La Soul would have you believe the magic number is 3, I want to talk to you about why the magic number is actually 5. That's if you want to retire early anyway. Today, I'm going to talk you through the 5 key variables I use when building retirement plans with my clients. They shape the entire outcome, and they help answer the big question we're all trying to solve. But before we get started, we need to talk about why these magic numbers are so important. It might be helpful to think of your financial plan like building a house extension, something my wife and I did just a few years ago and documented on this very YouTube channel. At first, it's all drawings and discussions. You'll make assumptions about cost, materials, and timelines. Who knows? You might even plan it better than me and end up with the luxury of a back door handle so you don't get stuck in the garden all the time. And just like with a house extension, those assumptions matter a lot. If your builder assumes materials will cost £10,000 but they actually come in at £20,000, this miscalculation could wipe out your whole budget. Even if you can complete the extension, you might struggle to put any furniture in it. Or maybe your builder estimates the project will take 3 weeks, but it actually takes 3 months. That's you and your family living in chaos and cooking microwave meals in your bedroom for far longer than expected. It's the same with your retirement plan. Small mistakes might not seem like a big deal in the early stages, but over the course of the build project, or when talking about your retirement, your career, small errors can compound and throw everything off track. And this is why you need to know the 5 magic numbers like the back of your hand. A financial planner can sense check your assumptions before you get started, making sure they're realistic, based on experience and sound advice, not wishful thinking. And just like you check in with your builder regularly throughout the project, they'll revisit your financial plan each year. Are things on track? Have the costs changed? Has anything unexpected come up? We can't predict the future with any certainty, but we can avoid building your house on sand. And if you want something to help with this, you can click the link in the description to get your hands on your free retirement guide. Now, let's get on with it, shall we? The first magic number is something that, done well, could see you retiring comfortably. Done badly, and you could be living off beans on toast in your later years. Although I have to say, I love beans on toast, so that isn't too much of a threat to me. To find out whether you've got it right or wrong, I want you to work out how much you've saved for retirement. Don't worry if the number is low. I'm more concerned about how you work it out. When most of us do a quick tally, we'll add up our pensions, ISAs, random investments here and there, any savings, and probably the value of our home too. We'll total it all up and think, that's what I've got to retire on. And you're on the right track, as the first magic number is working out exactly what you have. But there is a potential error in the thinking here. I understand why you've included your house. For many of you, it'll be your biggest asset, especially if you're mortgage-free. But it shouldn't form part of your retirement calculations. Because unless you absolutely know you're going to downsize or release equity in some way, its value is totally irrelevant when it comes to funding your lifestyle in retirement. You can't sell a bedroom to pay for your food shop. And unless you're unlocking some of that equity, as we've said before, that money is tied up. So if you're counting your home as part of your retirement pot, you're potentially overestimating just how much you've actually got to live on. Here's what to do instead. Track your actual retirement assets. These are the things you'll realistically spend from. Pensions, ISAs, savings, liquid and accessible investments. When listing your assets, keep a note of what is a retirement asset and what isn't. For example, if you have a rental property providing you with an income and you plan on keeping hold of it throughout retirement, the income is an asset for retirement, but the value of the house itself isn't. Not unless you'll sell it and realise that capital to spend on your lifestyle. At that point, the capital would become a retirement asset and the income from it would have stopped. Keep a record and review it all at least once a year. It doesn't need to be complex, just a quick overview so you don't lose sight of what's available. Use a decent compound interest calculator so you have a rough idea of where you might end up. There's lots online. I quite like this one, but with them you can put in some sensible assumptions on investment returns, contribution levels, and time invested, and see what the future might look like. If you'd like an expert to run the numbers for you, click the link in the description to book a call with me. I can help you close the gap between where you are now and where you'd like to be at retirement. Before I share magic number 2, let me tell you about a client who recently came to my office with what looked like a solid budget. They'd listed out all their expenses, set up some formulas in Excel, spreadsheet was even colour-coded. That last one isn't necessary, but it definitely looked impressive. If Disney did budgets, this was it. There was just one thing that didn't add up. When we looked at their actual bank statements and spending patterns on their banking app, we saw that their whole calculations were a work of fiction. They were missing meals out here, online orders there, the odd weekend away, all the little extras that didn't make it to the spreadsheet, but added up over time. You guessed it. The second magic number is how much you spend. In order to answer the question, how much is enough, you need a firm grip on your spending. Here's what I recommend. Start with a budget, even if it's basic. Something is better than nothing. Then, compare it to your real spending. Look at the last 3 to 6 months of transactions and see if it matches up. Then go back further and look back over 12 months to catch those pesky annual bills. Then, think about how your spending might change in retirement. You might spend more on travel, hobbies, or helping out your family, and less on commuting, work, clothes, or furniture, for example. And finally, think in seasons. When you're retired, what many people forget to factor in is that your spending will change and should change over time. You should think about your go-go years. These are the years you want to travel more, explore, try new things, work your way through that bucket list. That's when you should be spending the most. Next come the go-slow years, when you're still enjoying the nice-to-haves, but maybe you're travelling less and long-haul flights are a thing of the past. And eventually, the no-go years, where travel really declines and life becomes more about security and comfort, although there's always those potential healthcare costs to consider. Each phase brings different financial needs, and we need to consider them all. Out of the 5 magic numbers, number 3 is probably the hardest to calculate. To get you as close as possible, let me tell you about a client I worked with a few years ago who was convinced he wouldn't live past 80. Both of his parents had died in their late 60s, making it hard for him to imagine living much longer than that. Which I totally understand. Our opinions on these things are shaped by our own personal lived experiences. But when I built his financial plan and ran the numbers all the way up to age 100, he looked at me like I'd lost the plot. He asked, "What if I invest all that money and then die early?" And it's a good question to ask because I don't want anyone to not have a fulfilling retirement full of joy and spending and die the richest person in the graveyard, trust me. But we have to also consider my reply, which was, what if you don't invest all that money and live longer? Fast forward to today, and this client of mine is now aged 78, in good health and still very much enjoying life, and relieved that his investments are still going strong, and is now happy talking about what the next 5, 10 years and beyond might hold. As you've probably worked out by now, magic number 3 is life expectancy. It's hard to get it right, but we can certainly avoid getting it really wrong by underestimating how long you'll live. The latest UK data shows that average life expectancy is around 79 for men and 83 for women. But this is from birth. The funny thing about life expectancy is that it changes as you get older. If you're, say, a 45-year-old male watching this video right now, your life expectancy is actually age 84. But these are just averages. Plenty of people live into their 90s and beyond, whether you've met them or not. That same 45-year-old male actually has a 1 in 4 chance of living to 93, for example, on today's statistics. If you only plan to these averages, what happens if you live longer? You could run out of money just when you need it most. And there's another layer to this. Yes, even if we are living longer than, say, we were 100 years ago, that doesn't necessarily mean we're healthier for longer. According to government figures, healthy life expectancy in the UK is around 62 years. 62. It's really quite sobering that 45-year-old male we talked about might have a 1 in 4 chance living to 93, but he might only really have 17 more years of healthy years to enjoy himself. Even if you live to 85 or 90, there's a good chance you'll spend the last 15 to 20 years managing health issues, care costs, or reduced mobility. And we need to take this into consideration. So, what do you do with all of that? Plan for overall longevity, but think in seasons. I always recommend running your figures up to age 100. Yes, it's conservative, but if you do live a long time, I want to make sure you've got enough money to fund it. But that on its own is a recipe for being over-conservative and leaving too much money on the table. So by thinking in terms of seasons and spending more in the early years, strikes a happy medium between making the most of your retirement now in those healthy years and planning for those potential later years, which are important too. A while back, I met a client who came in armed with spreadsheets, forecasts, and the confidence of an 8-year-old swinging a sledgehammer at a load-bearing wall. He'd read that the stock market delivers an average return of 10% a year, and had worked out that if he invested £500 a month for 30 years, he'd retire with over £1 million. Fair play to him for genuinely coming up with a plan, but there were a couple of issues with these calculations. First, when people talk about getting a 10% annual return, they've usually based this figure on the S&P 500, which is a US index, a list of the 500 biggest hitting companies in America. In recent history, more so than ever, the US has dominated the stock market. But there's no guarantee that the US will stay on top in the future. This 10% figure is an average over many decades. Some years it gives you 20%, other years it takes 15% away. There actually aren't many years where the index itself returned this quoted figure of 10%. Such is the nature of long-term averages. If you go into your retirement expecting 10% year after year, you could be in for a shock, especially if you don't have the stomach for volatility. Because in order to build a portfolio targeted at that level of long-term growth, it would have to be very punchy and pretty high risk to give you any chance of hitting it, which will come with some big ups and downs along the way. The problem that can arise here is someone who was confident in the beginning can start catastrophizing at the first signs of real volatility and responding to what actually are perfectly normal ups and downs with poor investment decisions. They might stop regularly investing through fear of losing more, maybe take the money out of the market, crystallizing their losses, or chase extra return to repair the damage by picking individual stocks based on social media speculation in the hope of a quick win. Make any of these mistakes and you'll usually make things worse. So that's why the fourth magic number is setting realistic investment returns. The best portfolio isn't always the one with the highest return. It's the one you can live with, the one that won't give you sleepless nights or a cardiac arrest. So, what should you do? Use a return assumption that fits your risk profile. Our example here of a 10% return would need a full equity-based portfolio aggressively focused on growth. But if you're investing more cautiously as you approach retirement, don't plan for such aggressive growth with your forecasting. Adjust for fees and taxes because what you earn and what you keep aren't the same thing. And be a bit pessimistic. It doesn't hurt to stress test your plan. I rarely use more than 5% as a long-term return when I'm planning with clients, even for more adventurous investors. If the plan still works at 5%, that's a really good sign for me that you're on the right track. And this leads me to another problem with the 10% return idea. Let's imagine you're able to invest a whopping £1,000 a month for 30 years, and you manage to get that magical 10% return year in, year out. By the end of those 30 years, you'd have over £2.28 million in your pot. But before we start pricing up your yacht, let's talk about what that number actually means in real terms. Because today, 2.28 million would get you this 5-bed in Finchley, North London. You can pick your jaw up off the floor now, Northerners. I'm in the Midlands here, and that still blows my mind that I'd spend nearly 2.3 million quid on a house and have neighbours that close. Frankly, for that money, I'd want a castle with a moat. But how far do you think just under £2.3 million would get you in 30 years? You could expect something like this 3-bed in the same area. Still a fantastic house, but the bathroom won't be to everyone's taste. That's assuming inflation runs at 2%, bringing our pension pot's buying power down to 1.5 million in today's money. If inflation is actually higher than this and say averages 4% a year, you're looking at around 1 million in today's terms, which could get you something like this. It's still a perfectly good home, but it's obviously much smaller than the others, and now the neighbour is attached to you. You've probably worked it out by now, but the fifth magic number is inflation. It eats away at your purchasing power over time, and most people underestimate just how powerful it is. Not only does it affect the cost of housing, it affects every aspect of your spending, including food, holidays, and how much you give to your grandchildren for their birthday. A £2 coin done a Werther's original won't cut it today, Grandma. So, we need to work out what is a sensible rate of inflation to use when long-term financial planning, because that'll shape how far your money really goes. Here's how I approach it. I typically run projections assuming 2.5% inflation, a bit above the Bank of England's 2% target. But I also build in what-if scenarios. What if inflation averages 4%, for example? What if it spikes for a few years and then comes back down? Running those stress tests gives peace of mind. It shows whether your plan still holds up when the economy throws a curveball. Inflation might not seem like a big deal in the short term, but over 20 or 30 years of retirement, it can make or break the plan. But I appreciate that following all the steps on this list won't magically fill your pension pot. Knowing the magic numbers is one thing, but actually saving enough for retirement is a whole different challenge. So, check out this video next, where I share 5 really simple changes that anybody can make tomorrow to have a huge impact on your retirement with very little effort.